Yes, people, peace and blessings. Welcome back to the channel. Hope you're well and in good health. Okay, let's take a look at what is an ETF, exchange traded fund. So we're on Barclays here. So exchange traded funds are a popular type of collection investment that provides access to a wide range of markets. So let's take a look at their guide here at Barclays. So let's see what they deem ETF to be. So exchange traded funds, also known as ETFs, are popular among investors looking to build a diversified but low cost portfolio. So there are different types of ETFs with varying levels of risk. So you should have a solid understanding of how these work before one invests. So why are ETFs popular? ETFs offer investors access to a wide range of markets around the globe, usually at a low cost. Most ETFs are passive investments, meaning they simply aim to track the performance of an underlying group of investments. Actively managed investments, on the other hand, try to outperform the market and therefore charge more to cover the cost of employing a team of analysts. To put this into context, the ongoing charge for the iShares Core FTSE 100 ETF, which tracks the FTSE 100 index, is just 0.07%. However, if you invest in an activity managed fund, you can expect to pay ongoing fees and charges ranging from around 0.65% to over 1% each year of your total investment in the actual fund. The difference may not sound like much over the course of a year, but it will add up if you hold your investment over a longer period of time, for example, a decade. Right, passive investing may sound boring or dull, but research shows that the average active fund manager underperforms against the market once costs are taken into account. So, unless you pick a manager who consistently outperforms the market, it's worth considering the lower cost option of a tracker such as an ETF. Don't forget though, you still have to take into account any transactions and custody fees charged by your investment service provider. ETFs can also help investors build a more diversified portfolio. They're listed on the stock exchange, so you can buy and sell shares in them just like you would in any other company. So they can play a part of a wider portfolio, diversified portfolio. For example, you could have a real estate, so you could have property, you could have precious metals like gold, silver, palladium, platinum, bars, or whatever it might be. And then you could have some ETFs to diversify and spread the risk in terms of investing. So it also means you can build and rebalance your portfolio if you have ETFs relatively quickly and more easily. What's more, basically, ETFs don't just track market indices, they also invest in specific industry sectors like finance or healthcare, as well as other investments like the government or corporate bonds. Remember, regardless of whether you invest in an active or passive investment, it can fall in value as well as rise. So that's pretty much standard when you, for example, if you purchase crypto, it's a volatile space, it goes up and it goes down. So ETFs can all, the value of those ETFs can also go up and go down likewise, like many other investment types. You may end up getting back less than you invest. So, this is not financial advice, so you always have to do your own due diligence because you might invest and you might lose all your money. So remember that always seek professional financial advice before investing into any kind of asset. So, how ETFs trading and investing actually works. There are two types of ETF, a physical and then a synthetic. So, physical ETFs, exchange traded funds, invest directly in whatever they track. In the case of a FTSE 100 tracker, the ETF invests in the shares of companies that make up the FTSE 100 index. while, for example, a gold ETF invests in gold bullion held in an actual vault. Nevertheless, it's important to note that when you invest in an ETF, you buy a stake in the ETF itself, not the index tracked or the underlying investment. Okay, so that was a physical ETF. Then, secondly, we have something called the synthetic ETFs, which are more or a bit more complex. They purchase swaps, which is a type of derivative usually sold by investment banks, which promise to pay the same returns as the index or underlying investment they track. They allow you to invest in markets that might be hard to access otherwise, like perishable commodities or stock markets that restrict foreign investment. Okay, so synthetic ETFs are more high risk or riskier than physical ETFs due to what's known as counterparty risk. That means if the investment bank that has sold the swap to the ETF can't meet its obligations, you might lose out. Sellers of swap contracts usually have to provide collateral to reduce the risk. However, physical ETFs are easier to understand and less vulnerable to hidden risks, so they're more suitable for individual investors. Your money is still at risk, though, as well. So, as with the types of investments, the value can fall, so you end up with less than you put in originally. Okay, so how to invest in exchange traded funds, ETFs. As mentioned earlier, ETFs trade like shares, so you can add them to your portfolio relatively easily. So you see a lot of investors, individuals who have some financial capital that they want to pour out into the market to work for them, i.e., they want to invest in something that's going to get them a return on their investment over time. So obviously ETF, as we mentioned, the exchange trading funds is one asset. Other asset areas are like real estate, precious metals, and other areas as well. Some people, for example, deal in historical watches or expensive high value watches, big brands, or watches that have been around for decades that have high value in them. And then there's other things. I mean, I've even heard of people spending hundreds of thousands of dollars on baseball cards, of all things. Some of these baseball cards are rare and they hold a lot of value. So, yeah, you can hold most ETFs in an investment ISA, which is a tax efficient account that protects your returns from capital gains and income tax. This tax year, you can put up to £20,000 tax free into what's known as an investment ISA. ISA, you can also split your allowance between a cash investment, innovative finance, and a lifetime ISA if you want to, and all gains will be free from income and capital gains tax. However, with the lifetime one, you can only pay in up to about 4 grand. Tax rules are subject to change though, and their value to you will depend on your own personal circumstances and your financial position that you're in at the time you're investing and so on. Okay, people, there you have it. So that was a little bit a basic introduction into ETFs or exchange traded funds to see what it's all about, how it works, and a little bit of information around that. So, if you are interested, always do your own due diligence and seek professional financial advice, before you start to invest anything. Because, like I said throughout the article, you can make money, you can also lose money. So, be aware of that. Okay, people, drop a comment below. Let us know, have you invested in any kind of ISA or ETF, or do you have experience with these, uh, ETFs and exchange trading funds and so on? Okay, people, please do like, share, subscribe. Please support the channel if you like what we do by clicking the join button and become a member. Okay, people, catch you in the next one.